Hello, everyone. Welcome to our Chartsarefun weekly session. This is for the week of January 20th. Today is January 26th, the Indian Republic Day. India celebrates 76th Republic Day, having completed 75 years as a republic. So congratulations to India. We will look at the key benchmark on the Indian Stock Exchange called the Nifty 50. So we'll look at that. And also, this week was previous week was a huge week with AI announcements. There was a very big Stargate announcement in terms of $500 billion of investment in the space of AI by three key powerhouses. Oracle CEO, not CEO anymore, is the chairman and kind of the founder of Oracle, Larry Ellison. He playing a big role in terms of powering the data centers ahead. So 500 billion of investments by SoftBank's founder Masayoshi Son from Japan, and then Sam Altman, the founder and CEO of OpenAI. So a big announcement adds a lot of momentum to AI spending. We're talking about 500 billion of investment, starting off with 100 billion right away. They're going to set up data centers. There's already a data center being announced by Larry Ellison at Abilene, Texas, talking about 10 data like centers or 10 different buildings, each about 500,000 square feet. So that drives the need for utility. So there has been quite a bit of movement in utility stocks this week. More need for electricity. President Trump talked about an emergency in energy, so he is going to help power, clean, and perhaps alternative energies, but energy to start driving the generation of electricity within the outside, not just within the grid, but co-located to the data centers. Now, along with that news, Davos was a big thing this week, and Satya Nadella, the CEO of Microsoft, kind of affirmed his $80 billion investment in data centers for AI. He said he has the cash, he's committed to it. They've already spent over 25 billion in the first quarter of the year. The second quarter, we're going to be finding out shortly. And then by the June of this year is going to be when his financial year ends. He's expecting to spend 80 billion. We had previously heard Meta CEO and founder Mark Zuckerberg talk about 38 to 40 billion spent last year. He upped his spending, having seen the euphoria in AI spending. He's not going to be left behind. He upped his spending. He's talking about increasing from 38 to 40 billion to 60 to 65 billion in 2025. So we see a kind of a breadth of AI spending. Definitely the biggest beneficiary of this is going to be NVIDIA. They are powering a lot of the GPU chips. So their earnings is not till later in February, but all these AI spending could kind of drive the market higher. Now, come on, the key things to watch. There is out of the 7 in the Magnificent 7, we have announcements of earnings for 4 of them this week, in the upcoming week. On Wednesday, we will get earnings from Meta, Microsoft, and Tesla. And then on Thursday, we'll get the announcement from Apple. Apple, of course, has been a lot under the gun these days of a slowdown of sales in China. There's been news of almost an 18% drop of sales year over year in China in the fourth quarter. So we'll see how Apple, announces earnings. There's a fear of Apple dipping below $200. It's already fallen quite a bit from 260 down towards a test of 220. Since testing 219, 220, it's been rebounding a bit, but we'll see what happens. But we're just going to look at MAGS, which is a core ETF by Roundhill for Magnificent 7. And then do want to look at a big statement that President Trump made this week while giving his talk. He gave it remotely, but he talked about interest rates. He said that he demanded lower rates. And we know that there's a big FOMC meeting coming up this upcoming week. The Fed is going to meet over Tuesday and Wednesday. So we'll hear from Chair Powell on Wednesday afternoon. We are expecting, the market is expecting a fairly hawkish Fed, knowing that interest rates have, like from a 10-year yield, gone up a lot from around 3.6% when the September 18, the first 50 basis point cut was announced. So there was in succession 3 cuts over 3 back-to-back like 3 consecutive FOMC meetings, 50 basis in the first meeting in September. Then the next one in November was a 25 basis point, and then the one on December 18th was another 25. So 100 basis points of cuts have already been announced, but market now thinks that potentially, forget any more cuts, there might be increase of rates into 2025. Part of the concerns is economy that could perhaps continue to be strong. We've seen job data for December coming out really strong. There was expectation about, say, 150 to 160,000 jobs. The market, the job data announced was over 255,000. So over 100,000 more jobs than what was expected. Unemployment rate fell from 4.1 down to 4.2 down to 4.1. Inflation was also tame. CPI and PPI both beat expectations. It was expected month over month of 0.3%. It was 0.2% for both CPI and PPI. So market is thinking that perhaps there is going to be inflationary trend creeping up. There's, of course, going to be a lot of pro-growth kind of policies from President Trump and his administration. Corporate rates are expected to be slashed from 21% down to 15. They expect to continue the tax cut that they had done in 2017. They want to vote and continue it moving forward. And market is concerned about deficit spending. There's been a huge talk about deficit spending. So overall, market is concerned about inflation kicking back in this year. So that said, we will look at the 10-year yield chart. We'll look at what TNX is telling us. Correlated to that, we look at the long-term treasury ETF, which many people invest as an alternative to stocks called TLT. That's back to the 20-year treasury or higher maturity, but we look at that. And then we look at the core dollar ETF, which is called UUP. We look at what that's telling us. And correlated to the dollar is gold as an alternative to the dollar is gold and crypto Bitcoin. We know that President Trump has been extremely pro Bitcoin, wants to reduce regulation on Bitcoin, make it easier for larger investors to start investing. He's even talked about kind of having a strategic reserve in Bitcoins. But we look at what the Bitcoin chart is telling us. And another sector which has been quite a bit from expectations of doing extremely well, didn't do so well last year, was small caps. We know that if interest rates come down, it helps small caps. In particular, yes, call it the front end of the treasury, the front end of the curve has come down. The 10-year, like the interest rates from a treasury over the counter rate has come down from 5.25 to 4.25, but the long-term yields, the 10-year, which is directly correlated to mortgages, correlated to the housing economy, the loans that people take, has crept up a lot. So from 3.6, it's gone up to 4.8. People say, Ray Dalio and others, that an expected yield for a 10-year should be around 5 if the inflation rate is about 3% is where it's settling down. Add a 2% risk premium, 3 plus 2, 5 is where 10-year yield should be. So people think that 10-year yield at a 4.8 that it touched recently is perhaps kind of coasting towards 5 and being there till concerns of inflation coming below 3 is addressed by the market in terms of the data. So till we see some reasonably strong trends back of inflation coming down, market thinks that perhaps the rate for 10-year yield should be around the 5. So that does impact small caps. So if we, for any reason, see 10-year yield come down, then perhaps we will get some form of a counter trend move higher in small caps. So knowing looking out of potential having shown in the reforming here and to pull back in 10-year yield, and related with that, we think perhaps small caps, which is the core ETF for that for the Russell 2000 is IWM. We look at that chart and we think perhaps move higher from the 230 level is the key for IWM. It's been struggling there in terms of core resistance, bit of handle, cup and handle. We think it's headed towards the 247. So we look at that IWM chart. And finally, we'll end with the Magnificent 7. I talked about 4 of the 7 magnificent stocks having earnings this week. Look at what the MAGS, which is the Roundhill ETF of Magnificent 7 telling us. So I'll share my charts now. Thank you. So here's our blog site, the Chartsarefun blog site and Substack. We appreciate you subscribing to it. You just share your email and you'll get the blogs when they're published. We tend to publish it daily. We end with a weekend blog, which talks about weekend chart patterns. You can look at the one that we just published yesterday. This was more about the utilities and some of the top five utility holdings, the XLU and its top five holdings. Our YouTube site is, the channel is called Charts Are Fun. Yes, we do think charts are fun. We see a lot of cool insights coming out of charts. We'd appreciate you hitting the like button if you like our videos and subscribing to our channel. I talked about India celebrating its 75 years as a republic. 26 January is India's Republic Day. Wanted to look at the core index for India, the Nifty 50. There's been a huge move last year for small caps in India. However, large caps had kind of played a bit of a back seat last year. Overall, as an index, been a reasonably an 8.8% kind of a year for the Nifty 50. On average, if you look at a 25-year time period, India's Nifty has been on annual growing at anywhere from 12.9 to 13%. So it was a below average year last year. But if you look at a near-term chart in terms of this is a daily chart, what we see here is a bullish wedge. It's a falling wedge, but it's a bullish wedge. The way a bullish wedge works is if you join the peaks and you join the bottoms, they kind of converge down from a broader to a narrow part. So here the declining tops and the declining bottoms are coming down along a wedge. But as the wedge is forming, we see a beautiful positive divergence. That's explained by the RSI, the momentum indicators, RSI and MACD, both forming higher lows. That means momentum is saying that, look, the decline is kind of abating. It's going to start improving in momentum while price is coming down. We think there's a turn back possible. Of course, India's budget gets announced on February 1st. There's expectations for perhaps some pro-market friendly moves. There's also expected rate cuts in India. Many are calling for 100 basis points of rate cuts. Of course, the Reserve Bank of India is going to be very cautious with rate cuts, knowing that they don't want to stoke inflation. India has managed inflation really well post-COVID, unlike many of the other countries. So we'll see. We'll see what India does. There has been concerns of GDP slowdown. India expected, from what the investors, foreign, worldwide, expect 8% GDP year over year. However, the first half, India slowed down to a 5.6. So this year for 2024 to 25, India's fiscal year is from April to end of March, is expected to be anywhere between 6 to 6.5%. So we'll see how the latter half of the economic year comes through end of March. But with any pro-growth kind of policies in the tax and from the government, perhaps could cause a little bit of a recovery here. But many are thinking that large cap stocks in India have taken a back seat. Perhaps they will be beneficiary. There's been this very high valuation wise, P/E ratios of small caps overshooting the overall market. So perhaps time for the large caps whose P/E have been more of a kind of much lower than what the market P/E was, to play a better role. So we'll see what happens. But this chart of Nifty shows what I call or what the technicians call as a bullish wedge. It's a descending wedge, but a bullish wedge with an expected reversal higher. We're going to now look at 10-year yield, which, with the key FOMC meeting this week, President Trump talking about demanding for lower rates. 10-year yields are not connected by what the FOMC does. FOMC's interest rates are, of course, the kind of the front end or the shorter term rates. But the 10-year yield is inflation expectations, the economy expectations, and overall where the market thinks about the 10-year rate should be. But here, technically, it's setting up for a bit of a head and shoulder top. As in, we can see a neckline around the 4.55 level. You can see a left shoulder in the late December part, pull back to the neckline here, 4.55, a move to 4.8 by mid-January. Since then, after the inauguration, the last week was the inauguration, we see it came back down to 4.55. Bit of a right shoulder move up from 4.55 towards the 4.65 or so. And now, potentially, depending on how, as the market thinks a hawkish Fed, but any signals of maybe a bit of dovishness from Chair Powell, maybe he kind of talks about his data-dependent policies and so on. we'll see what it does, but there's a potential for the 10-year yield, the TNX, breaking below 4.55. The measured target on this head and shoulder move is to 4.29%, which is closer towards the test of the 200-day moving average near 4.25. That's the expectation. And if that happens, inversely correlated to 10-year yield is the TLT, which is the long-term treasury ETF, which many people invest as an alternative, as a hedge against the stock investments. This is a beautiful inverse head and shoulder pattern forming. So here from the left shoulder, we see forming around the December timeframe when the left shoulder of the 10-year yield formed. Then we had the head from somewhere around 8.88 to 85, 84.89, back up to the 88.17. The right shoulder formed over the last week. Now it's setting up for a break higher. So if the 10-year yield breaks below 4.55 and comes down, expect the TLT to break higher from this inverse head and shoulder. The measured target is 91.45, not too far from 91.34. It's 200-day moving average. So expect the 200-day moving average coming for both the 10-year yield and the TLT. One from below up on TLT, rallying up from right now it's at $87 up to the 91.45, and yield coming from 4.55 towards the 4.9. Now, also correlated to this directly is the dollar. If we expect that the 10-year yields will come down, it means that there's a good chance the dollar continues its downside. We saw a breakdown of the dollar from a descending triangle on Friday. We see a descending triangle from a horizontal line of support near 29.35. The peak was 29.9. We see a negative divergence as the dollar UUP ETF went from 29.7 to 29.9. That's a higher high-end price, lower high in RSI. That's a negative divergence. That's how a near-term top forms. So we expect the UUP to break down further. The measured target is 28.8. So if the dollar comes down, it'll be directly correlated to the 10-year yield breaking down. So lower yield means a lower dollar. Now, inversely correlated to the dollar, if the dollar comes down, what could be beneficiaries is the alternatives to the dollar, which is gold and Bitcoin. We see a very beautiful pennant forming on the Bitcoin chart. This is BTCUSD. USD is the ticker for Bitcoin. This trades 24/7. A beautiful cup and handle in anticipation of pro-growth, pro-crypto President Donald Trump. From 184 on the left part of the brim of the cup, it pulled down to 89.1. From 89.1, it moved up to 109.3 2 weeks ago. A beautiful pennant shape forming, and now the breakout coming from that. Expected breakdown in dollar could correlate with the breakout of this pennant for the crypto. The measured target is from 89.1 to 109.3. That's $20,200. At $20,200 to 109.3, that goes to 129,500. So that's the target for Bitcoin. I think this is a great time to start looking at big upsides in the miners, Mara and Riot, for example, and also in the various ETFs. You have Grayscale's ETF, GBTC, you have Fidelity's ETF, FPTC, you have IBIT, the iShares Bitcoin ETF. So those are great instruments to look at for this upcoming breakout in Bitcoin. Correlated to 10-year yield coming down would be a direct beneficiary would be the small caps. We talked about small caps are extremely interest rate sensitive. If you do see the 10-year yield coming down, this is a kind of a cup and handle, a little bit of higher brim on the IWM, the ETF for small caps, pull back to 213.97, up to the 230. 230 is also where we noticed 229.75 is where the 50-day moving average here is in blue, but also key resistance from the past. So here, that 230, this 50-day moving average, if that breaks out higher after a bit of a handle, kind of a consolidation along a handle shape here, that breakout measures to 247. So reasonably good upside expected in small caps over the next few weeks as we see the 10-year yield come down. So we'll see what happens in the upcoming week with the FOMC, but expecting a breakout higher in small caps. And finally, I talked about the Magnificent 7 ETF, Roundhill. This one, if you look at cup and handle. This cup and handle formed way before even the election results in the month of October. So 49.57 was the July high. That's when NVIDIA had topped, broke down to 38 by the Japanese stock market crash on August 5th. A very sharp rise back to 49.59. So this is the cup, 49.57 to 38, back to 49.59. A bit of a shallow handle. And then to the month of November, we broke higher and continued to climb. Right now, a bit of a flag, kind of a pullback, but about to break out from this bullish flag higher. That measured target is not far from where we are right now. We are somewhere around 56. We're talking another $4 of upside in the Magnificent 7 ETF. So here, the measured target on that comes from a 38.21 to a 49.59. That's 11.38. Add 11.38 to 49.59, you get 60.97. That's where the very close to 61 is where we think the Magnificent 7 ETF goes. And we'll see what happens with the 4 big Magnificent 7 stock that are going to announce earnings this week. As we said, Wednesday is going to be Microsoft, Tesla, and Meta. And then on Thursday, we'll have Apple. With that, good luck investing. Reiterating and kind of summarizing our thoughts, we think that India, Happy Republic Day. We think India is looking for some upside with the budget coming up on February 1st. Wouldn't be surprised to see a reversal higher. Measure target on this will depend on where it finds the initial level of resistance and then consolidates. But if it moves from 23 to 24.9 and base is there, that's about a 1900 point base. And from there, if it breaks higher, 24.9 by 1900 could get it to above the previous peak from September at 26.3 towards closer to the 27,000 is where potentially India could reverse higher in the next few weeks. 10-year yield, this breakdown from the head and shoulder top measures down to a 42.95, which is closer to 4.3%. We see that the 200-day moving average is 4.25. So somewhere around 4.25 to 4.3 is where you think 10-year yield could be coming down. This would directly correlate to an upside move in TLT, the long-term Treasury yield ETF, and a move from somewhere from 87 to 91.45 is what I'm looking at. The dollar, we expect further downside. It just broke down on Friday, as I said, on very heavy volume. This is a descending triangle. So it just broke down, closing at 29.2. The measured target is 28.8. So there is downside expected in the dollar. Bitcoin, from a dollar weakness, would get a nice breakout higher, a beautiful pennant shape forming from the handle. Instead of being a typical, flat kind of handle, this is more of a pennant handle. A beautiful cup from 108.4 on the left part to 89.1 to 109.3. That's a $20,200 move from 109.3, measures 229. So expecting a decent upside in Bitcoin in the next next few weeks. Similar thing with small caps, expecting a cup and handle breakout on that. On the IWM, break above 230, measures to 247. And finally, Magnificent 7. Not as much upside, but from where it's at 56 towards the 61, $5, a little less than 10%, 9% move is expected in the Magnificent 7 over the earnings season, starting with 4 earnings this week and then 3 additional. 2 of them will be the following week, Google and Amazon. And then late in February, we'll see NVIDIA, the last of the Magnificent 7 announcing earnings. Good luck. Happy investing.